Ladies and gentlemen, thank you for joining me. There are new trends forming in the precious metals market, and we want to take a look at these with this midweek update. My name is Christopher Aaron, and this is the iGold Advisor channel. Now, this week we're also going to be looking at gold and silver as priced in the Australian dollar. Before we do so, I want to share with you one of my core beliefs regarding the market. Now, I've been studying the day-to-day, hour-to-hour price action in gold and silver for the better part of the last 10 years, almost obsessively at some points. And I've noticed some things that I feel are worthwhile to share with you. One of my core beliefs, core understandings after studying the markets for so long is as follows. The price that we see on a given day is the equilibrium between supply and demand. This is basic economics 101. The chart showing the price shows the sum of all the buyers and sellers in the given market. By studying the trends in the price, we can observe trends, changes in patterns of behavior for all the market participants, including investors, traders, stackers, hedgers, speculators, central banks, institutions, hedge funds, and of course, manipulators. So, understand a little bit where I'm coming from. The last presentation, we started off just looking at the historical fundamental fact that no currencies are tied to anything tangible today. That is a fundamental fact. The market decision on that fact is a completely separate set of circumstances. So I've learned over the last number of years, it is not enough to simply understand the fundamentals. We have to pay attention to what the market is telling us. And that is one of the primary things that I try to bring to you in these presentations. For example, looking at the action over the we're now looking at the last month of action since the Federal Reserve rate hike on the 16th of December. And there are starting to appear some very interesting divergences. We had hints of these. If you go back to the presentation I gave a couple weeks ago, right after the Fed meeting, we had hints of these divergences. And we're now getting something more like a strong hint, let's call it, after a month. So we're just looking at major world asset classes over the last month. And we can start to see this divergence here. Rising over the last month are gold, silver, United States 20-plus year bonds. Relatively flat is the US dollar, up just about 0.5%. And significantly down now are US stocks and worldwide commodities. Now, the interesting thing is that this commodity fund includes, yes, it includes oil. Yes, it includes natural gas. It includes wheat, corn, soy, palladium, platinum. But it also includes the precious metals. So we're looking at an average of all these commodities down here. And this is now starting to become a significant divergence between the precious metals and the other commodities. About a 10 to 11% divergence here over the last month. So something is happening to the precious metals. And these are the types of shifts that I pay attention to in the short run that lead me to suspect that we are approaching a significant long-term bottom in the precious metals here over the next several months. The final low may not be in yet, but these are the clues. Looking at the gold market over the last 3 days, so we had closed last week right around 1100, falling back for the first couple of days of the week before a nice little rebound today, taking us above 1090. Now, remember this level right here where we bounced off of 1080, because I made reference in the last presentation to 1075 as being the level that I want to see held. Looking at this chart over the 6-month time frame, we always look over multiple time frames because it's really not enough to either look at the short run or the long run. We have to take a summary view of the markets. So the 6-month time frame, we've been looking at this low that was forming here in gold since November, finally breaking above this double black line here about a week ago, and coming back right here to test this double black line. So you will see that I often make note of these tests, these retests. After a significant level is broken out of, the market will often come back and retest that level. So we saw that retest when gold hit around 1080 and a modest rise away from that level today. So this looks like a good retest here. We want to see this hold. We want to see 1075 hold on any further weakness to confirm this intermediate term low. Of course, I'm using the GLD fund, and so the numbers don't quite match up with the actual price of gold just for the 6-month time frame. But you'll see when we move to the 2-year time frame that this corresponds on a 1-to-1 ratio with the actual price of gold. So we can use this fund just to track the short run here. Switching over to look at the gold mining complex, the GDX fund of gold miners, and we continue to see the relative outperformance here, holding above the summer lows, whereas the price of gold had fallen below the summer lows and has now rebounded. So that was a nice signal. Now, you'll notice the GDX fund made an attempt to break out of this intermediate term downtrend, this primary term downtrend, and it failed. So it hit that. You'll see that on the next set of slides, how important that test was. It still hasn't broken out, even though it is held above the lows. Looking at gold now over the 2-year time frame, and what can we notice? Well, a few things. Here were those lows that I was talking about, the grinding lows. Here was the break above the lows, the double black line. And here was the recent retest right back into the double black line. So, yeah, this is a short run perspective here, but this low is significant because it is the 1, 2, 3, 4, 5th time that this trend line has held. And of course, we are waiting. Every time we bounce off this trend line, we're waiting for the next attempt to break above this parallel trend line for a strong confirmation that the final low was in. So that's why this is so important sometimes to look at the short run to gauge the intermediate term perspective. Now, another thing that we're looking at here that I'm highlighting in green is just the incredible outperformance that gold has shown above and beyond the CRB commodity index. We made reference to that in that first chart. We were showing the relative performance. Here we're just showing gold relative to the CRB, making a new high on this most recent up leg. So basically, gold moved higher over the last few days, and the rest of the commodities kept moving lower. So we are seeing something happening to the precious metal of gold here. Let's look at the mining complex over the same 2 years. There's a slightly different pattern forming here. We are in this wedge-like consolidation. You can see by the convergence of these primary blue lines that will at some point break to the upside. After this long bear market, we would expect a break to the upside. However, this most recent attempt just 3 days ago failed. So we've had 1, 2, 3, 4, 5 hits on the upside of this line for the gold miners. It hit it and then has fallen back to this teal short-term uptrend line here. Now I stick with these colors. If you're new to the presentation, I stick with all these colors for basically every slide that you'll see, and even looking at the different time frames, I stick with the same coordination system here. I just find this really helps your vision when you're looking at the trends. The blue really sticks out as a primary trend, and within that we have these other colors. We have the teal for a short-term trend. We have the turquoise for a broken trend line. And right now we find ourselves still within this primary downtrend. We have another attempt here for this to break out. It looks like forming over the next several weeks. So I'll be watching this very close, because a break of this downtrend by the gold mining complex will be an immense indicator that in the near future, gold itself should start rising. We don't have that quite yet, but I'm looking at that here. Looking at silver now over the last 3 days. So there was some weakness again, some grinding action earlier on in the week before this nice close today, popping up above the $14 level again. This $14 level is really being disregarded by the silver market. This is not an important resistance or support level. It's been moving above and below 14 for the better part of the last month. There are some other important support and resistance levels. We'll be looking at those. So you can see that here again, we're using the SLV fund. So the numbers on the y-axis do not perfectly correspond to the price of silver on this short-term 6-month time frame. The numbers will be correct when we look at the 1 or 2 year time frame. But we're just using this so we can zoom in here. We were watching this back and forth kind of triangular consolidation. We had a short break below that a few days ago before coming back into it now. So we're not really seeing any strength here yet in silver. We're seeing relative strength, though, compared to the rest of the commodity complex. Looking at silver Wheaton, which is the strongest of the 20 or so silver miners that I follow on a regular basis, we are looking at silver Wheaton having basically come back down into its lows here from the summer, the August-September time frame. Now we had that outperformance here, silver Wheaton dropping back in the last couple days and retesting these lows right now. So this is something I'm watching very closely, because if silver Wheaton breaks down below this $11 per share level, this is giving me a strong indication that silver will have another drop coming up, which will probably be in the range of 50 cents to $1, perhaps $1.50 or so, depending on how far silver Wheaton falls. So again, I am bullish on precious metals as a long-term investment, but I am trying my best to bring to you what I see happening here in the short and the intermediate run, so that you can perhaps take a step back and wait to see if we get this drop before deciding whether or not to purchase some more. So we are looking again at the 5-year time frame, and this just gives us a better perspective as to the bottoming formation. We call this a wedge when it forms after a significant multi-year decline, and we see the convergence of the highs and the lows. This tends to represent a bottom forming. So mind you, within this wedge, we still have the possibility of a drop. You know, we're looking at prices here around $14 today. We still have the possibility of a drop, perhaps down to 13, perhaps down to 12 or so. before I expect this wedge to break out. So we are keeping those possibilities in mind. However, we're looking at here, again, from another perspective, silver that has been outperforming the commodity index, the CRB index, especially here over the last 6 months. A significant outperformance, which tends to lead to a bottom in the price of the metal itself. So we are going to turn our attention to the Australian dollar. I have received some feedback from people who are watching from Europe, Great Britain, Canada, and the other big one tends to be Australia. So I do want to provide some analysis on that. Of course, there are people from many other countries. Welcome to everyone. I'll just try to provide the best analysis that I can on as many perspectives as is feasible for me to do so. But we look today at the Australian dollar. Let's start looking at the price of the Australian dollar first, just versus the US dollar over a 15-year time frame. Now, we can observe that there was a long-term uptrend in the Australian dollar from the year 2001 that held into the crash of 2008 and has just broken here in 2015. Of course, the Australian dollar, starting this time frame that we're discussing, basically at the 50 cents. So in other words, it only took 50 US cents to buy one Australian dollar back 15 years ago. And then over the course of the next 10 years, the Australian dollar outperforming the US dollar by over 100%. In other words, no longer 50 cents to buy one Australian dollar, but one Australian dollar being higher valued than one US dollar, getting up to $1.10. So there was a massive move here on the Australian dollar versus the US dollar. Now, since the high in 2011, which corresponded, mind you, with the highs in gold and silver, we've had this drop in the Australian dollar, breaking this significant long-term uptrend here, and we find ourselves in a series of declines. The primary decline, we're still calling this here in blue, the shorter term decline in this teal color. So we can see that we are basically just fading here in the Australian dollar. A significant level of support here right around 68 cents. But I would not be surprised to see this fail over the course of the next several weeks or several months, and perhaps a retest of this crash low from 2008. Right around 60 cents. Now, before we get to the price of gold, I want to look at a comparison. There's often a comparison made between the Australian dollar and the Canadian dollar. There's some similarities between the countries, and mind you, we're just talking economics right now. I'm not making any sort of judgment toward the people or the beauty of the country or anything like that. I've traveled extensively both in Canada on the east coast and the west coast of Canada, and I've traveled extensively in Australia too, and I really love both countries, but we're just talking about the currency here. There's some similarities between the countries. For example, population, roughly similar. I think there's around 30 or so million, 35 million people living in Canada and slightly above 20 million living on Australia. So similar numbers. Both economies are highly resource-based economies, right? Both Western democratic countries with a high level of resource utilization in those countries. So we often see the two countries compared, and let's just look at the difference in the currencies here between, on the top, the Australian dollar, and on the bottom, the Canadian dollar. So there absolutely are similarities. For example, both currencies right now trading at 70 cents versus the US dollar. But just look at some of these subtle differences here. Whereas the Australian dollar, when it crashed in 2008, it then rose above its former high in 2011. The Canadian dollar did not. The Canadian dollar failed to rise above its previous high. Similarly, the Canadian dollar, we can see, has now fallen below its crash low, whereas the Australian dollar is holding above its crash low. So we can say that there is some relative strength in the Australian dollar versus the Canadian dollar, and we can probably attribute that strength to what's happened in the energy markets recently. We talked about this last presentation. The decline in oil that we've seen, there's a significant higher percentage of oil extraction coming from Canada, from conventional, also shale oil. And so this is playing into the relative weakness in the Canadian dollar that we're seeing compared to the Australian dollar. So I just bring that up for comparison purposes. Yes, the Australian dollar has fallen, but I would say the economy in Australia holding up better than some of the other resource-based economies. Let's turn to gold. We're looking at the Australian dollar price of gold over the last 15 years again. And what can we say here? Well, the Australian dollar price of gold really has not come down very far relative to where it was 5 years ago. So the price hit a high of right around 1,850 Australian dollars in 2011, and we find ourselves today right below 1,600. So you've only had about a 20% drop here in Australian dollar gold. Now, I want to make a couple of points about this. Yes, we have had this break of the uptrend line here, the long-term uptrend line. But the point that I want to make is Australian dollar gold is really not a cross-currency that is traded very heavily on the markets. Most worldwide traders for gold and silver trade in US dollars. So when we're making these trend analysis comparisons here for Australian dollar gold, we're really just looking at the physical purchases. We're looking at the price for most people buying physical gold and silver in Australia. So I'm hesitant to use this chart to really make a whole lot of predictions, except to say that when I look at this currency, I do not see a whole lot of weakness here in the gold price. And when we see these other currencies holding up really strongly in gold, it gives me one clue that there is a worldwide phenomenon happening with the price of gold that is independent of the US dollar. So it is easy to say that, hey, perhaps the US dollar is rising, the dollar index, and therefore let's jump to a conclusion to say the price of gold will be falling in US dollars. Certainly that has happened, but you have to look at gold as a worldwide commodity. So when we see this strength here, relatively speaking, in Australian price gold, it gives us another data point that this is a worldwide currency debasement phenomenon that we are observing. Zooming into the Australian dollar, over the last 5 years, the Australian price of gold, you're just looking at that decline here, this really modest decline. The area of strong support coming in between 12.75 and 13.25 Australian dollars. So I would say as long as this price holds here, the gold market is looking fairly strong in Australia. And boy, when this price breaks through 1625, this primary blue downtrend, this is going to be a strong early indicator that perhaps the lows are going to be in some other currencies relatively soon. Switching over to the Australian dollar price of silver, a lot of similarities to the US price of silver, but some distinct differences. We see still a long-term uptrend that is very much in play, being hit right around here, around the $20 mark. And we see an intermediate term downtrend that was broken here in the later part of 2014. So the uptrend's still valid. Let's zoom this in. We can see that broken downtrend line here with the uptrend still in play. And this basically from the middle part of 2013 looks like a really nice bottoming formation. You had some continuing lows into 2014, and since that time, really some back and forth consolidation, still respecting this uptrend line. So this entire kind of rounding low here looks very nice to me. I would suspect, this is still a guess at this point because I'm not willing to say it for certain until perhaps we have this $23 level taken out. But it's my strong suspicion that this spike low here in December of 2014 was the low for the price of silver in Australian dollars, right around 17. So this looks strong to me. If I were in Australia, I would continue with an accumulation program. If I see this uptrend line break, and if we confirm this with some other currencies, I will bring that action to you. We would have to take a step back and reassess, perhaps take a look at a double bottom around 17. But as of now, this is a really nice bottoming looking consolidation for the Australian price of silver. Thanks for sticking with me, everyone. Just to wrap this up in summary, we have gold retesting the 1075 breakout. We are still looking at the miners holding a short-term uptrend. We are noting the relative strength of the gold and silver markets relative to other commodities, especially the energy complex. Silver Wheaton on the silver side is right now retesting its lows. Its summer lows around $11 a share. Should it break, we are looking for possibly a move lower in silver that would include a potential for $12 over the course of the next couple weeks, perhaps a month or two. Don't have that confirmed yet. I'm watching this break potentially in silver Wheaton, and I'll bring you that update this weekend. Thank you so much for staying with me. My name is Christopher Aaron. We'll see you on Sunday evening, and have a nice rest of the week, everyone.